Have you noticed that in recent years, whenever the U.S. stock market dips, Bitcoin seems to follow it right into the abyss? And when tech stocks take off, Bitcoin rides her tailwinds. If you've been in the crypto market since the beginning, you know it wasn't always like this. In the early days, Bitcoin was like a deserted island. Nothing happening on Wall Street seemed to affect its price, but the game has changed. This video is based on a groundbreaking study titled From Network Fundamentals to Macro Financial Integration, the Evolving Predictability of Bitcoin Returns. This research was conducted by Rafael B, Palazzia and Gerson de Souza Raimundo Jr. from the University of Sao Paulo, USP, along with Marcelo Cabus Klotzle from PUC-Rio. Analyzing data from 2014 all the way to 2025, they proved that Bitcoin has undergone a true financial metamorphosis. What started as an experiment by programmers on internet forums has transformed into a vital gear in the global financial system. But what caused this shift? Was it the entry of major institutions like BlackRock? Or has Bitcoin lost its essence as digital gold to become just another risk-on asset? In this video, I'm going to show you the behind the scenes of this evolution based on this academic evidence. We'll discover the magic indicators, known as on-chain metrics, that continue to predict Bitcoin's price regardless of what happens in the traditional economy. If you want to understand why your investment behaves the way it does today, you need to understand the four regimes that Bitcoin has passed through. Let's dive straight into the story. To understand how Bitcoin became this financial giant, we need to go back to 2014. The study we're analyzing labels this period as Regime 1. Imagine Bitcoin back then not as a global currency, but as a tiny, isolated island in the middle of a vast ocean. In this phase, Bitcoin was driven almost exclusively by internal events, what academics call idiosyncratic factors. If the U.S. Federal Reserve raised interest rates or the stock market melted down, Bitcoin barely even noticed. It had its own demons to fight. The biggest of them all was a collapse of Mt. For those who weren't around back then, Mt. was the world's largest exchange, handling over 70% of all Bitcoin transactions. When it declared bankruptcy after a massive hack, the market went into a state of total shock. The price plummeted, but notice something fascinating. The crash was caused by a structural failure within the crypto ecosystem itself, not by a crisis in the traditional economy. The study highlights that the great challenge of this era, spanning Regime 1 and the beginning of Regime 2, was low liquidity. The market was shallow. Since there were very few professional buyers and sellers, any decent-sized sell order was enough to send the price screaming into the abyss. In this island era, Wall Street variables had zero predictive power over Bitcoin. If you want to know where the price was headed, looking at the S&P 500 was a waste of time. You had to look at what was happening inside the network itself, the on-chain metrics. Bitcoin was a technological experiment just trying to survive its own turbulent childhood, with no idea that in just a few years, the suits from Wall Street will be knocking on its door. If the previous era was an isolated island, 2020 was a moment a massive bridge was built between that island and the financial mainland. The paper identifies this as the start of Regime 3, marked by a seismic shift. Bitcoin stopped being a toy for tech enthusiasts and became a macro asset. It all started with the shock of the pandemic. When the world ground to a halt and governments injected trillions of dollars into the economy to prevent a collapse, the profile of the Bitcoin investor changed. Major institutions, hedge funds, and publicly traded companies began looking at the asset not just as a curiosity, but as a hedge or a high-growth bet. At that moment, the study shows that the decorrelation magic vanished. Bitcoin began behaving like tech stocks on steroids. If the Federal Reserve signaled easy money, Bitcoin surged alongside Apple and Amazon. If the stock market panicked, Bitcoin was sold off to cover losses in other areas. This integration brought what the article calls nonlinear information flows. Basically, Bitcoin became sensitive to the global mood. The entry of giants like MicroStrategy and later the hype surrounding ETFs sealed this marriage. Regime 3 marks the end of Bitcoin's adolescence. It gained liquidity, it gained respect, but in exchange, it lost its independence. Now, it's part of the same ecosystem as gold, oil, and NASDAQ stocks. From this point on, to understand Bitcoin, you didn't just need to understand code anymore. You needed to understand macroeconomics. Now, you might be thinking, if Bitcoin now depends on what the Fed does, have network analysis and blockchain technology lost their value? The study brings a fascinating answer. No. Even with all the influence of Wall Street, the research proves that Bitcoin still possesses its own DNA. There are silent signals happening inside the network, known as on-chain metrics, that continue to predict the price across every single regime from 2014 until today. The most powerful metric cited by the researchers is the MVRV market-to-realize value. Put simply, the MVRV compares Bitcoin's current price to the average price people actually paid for it. When this indicator is very high, it means almost everyone is in profit and greed is at an extreme, a classic signal that the top is near. When it's very low, it indicates capitulation and a historic buying opportunity. The paper shows that MVRV is the network's most reliable thermometer, working independently of external crises. Another vital signal comes from the derivatives market. Funding rates. They show how much traders are paying to bet on the upside or downside. If rates are too high, the market is over-leveraged, creating the perfect storm for a mass liquidation. The study's conclusion is that while the macroeconomic landscape sets the wind direction, these native metrics show the health of the engine. Bitcoin might follow the NASDAQ, but the cycles of profit, loss, and leverage of crypto investors are still the best indicators to know when the price is about to pivot. If you ignore what's happening inside the blockchain, you are operating with only half of the information available. If the pandemic era was a marriage, the 2022 to 2024 period was the ultimate trial by fire. The paper identifies this as Regime 4, the moment of the deepest integration in history. This was when Bitcoin faced its first major global monetary tightening cycle, the infamous tightening. When inflation skyrocketed and the U.S. began hiking interest rates at the fastest pace in decades, something shifted in the data's DNA. The study reveals that nonlinear information flows from traditional markets to Bitcoin reached their peak. Translating from econ speak, Bitcoin became hypersensitive to every single word uttered by the U.S. Central Bank. During this phase, the article highlights that macro variables, such as U.S. Treasury yields and the dollar index DXY, began to cause Bitcoin price movements with unprecedented precision. It was no longer just a visual correlation. It was a structural dependency. Bitcoin survived this test, but the cost was imported volatility. As the saying goes, if Wall Street sneezes, Bitcoin catches a cold. Regime 4 proves that Bitcoin is no longer a hedge against the system in the sense of being immune to it, but rather an integral part of it. It has become the most sensitive risk thermometer in the modern financial world. If you want to know where Bitcoin is going today, you absolutely must know what the Federal Reserve is planning for tomorrow. We've reached the end of our journey through the evolution of Bitcoin. The Brazilian study we analyzed leaves us with a clear lesson. Bitcoin is not the same as it was 10 years ago. It has matured, crossed for distinct regimes, and become a pillar of the global market. The big takeaway is that while Wall Street and the macroeconomic landscape are now the masters setting the pace and direction of the market, on-chain metrics, like the MVRV, remain the network's beating heart. Macro defines the context, but internal valuation and leverage cycles still determine the price extremes. Today, Bitcoin is a hybrid, half disruptive technology, half traditional financial asset. But this leads us to a critical question. With this total integration into Wall Street, can Bitcoin still fulfill its original promise of being an independent alternative to the financial system? Or has it just become another pawn on the big bank's chessboard? What do you think? Let me know in the comments. Do you prefer the isolated and independent Bitcoin of the past, or this new institutional giant? If you enjoyed this video, please leave a like, subscribe to the channel, and share it with others. Thanks for watching, and I'll see you next time.